AI is going to replace your job if you're not doing your job. And so I think in terms of business process outsourcing, wherever there's value to be had from the role that someone's playing, the jobs will follow that, regardless of the technology.
I did my first startup in 2000, and it was the sort of start of the internet as a business tool, and I built a digital trading platform, and I asked myself the question, how long before, say, the London insurance market will trade digitally? And I thought 3, 5, 10 years. 25 years later, we're still grappling with it. This next session is going to ask a whole series of questions about where will we be in 10 years' time. So at one end of the vision, you've seen what Will and Federato can do. How much is that going to change the industry? Do you believe in it? Is it going to happen now? We're going to get a panel, and we're going to put some questions up, and you're all going to have to participate in this. Do we think the industry will have fundamentally changed in 10 years, or is this all sort of hype, and a bit like me, you'll build a business based on the fact that change will happen much quicker than it does? Andy, starting with you, you're my age, you've been around a long time. Will we still be blaming legacy tech as the reason we can't go digital 10 years from now?
I think we are in a situation where today's cutting edge is tomorrow's legacy. I think that's just a natural factor. I do think that the nature of the problem will change in that clearly one of the challenges has been data migration and data harmonization, and we can see how technologies have changed that. But I think that the solutions which, as I say, were cutting edge 5 years ago are problems today, and I don't see that that's necessarily going to change going forwards.
At the risk of provocation, are you going to be the legacy tech in 10 years' time?
I hope that we're the industry standard legacy tech, yeah.
Good man. Yeah, and hanging around for 25 years after your shelf life has naturally finished.
I'll be on a beach. I'll send you a forwarding email.
Paul, any thoughts?
My favorite nerd joke, and this goes back quite a ways, is how did God create the universe in only 6 days? He didn't have an installed base. So yes, I think that's the natural order of things, and I think legacy technology will always be a problem.
Tracie?
I would kind of add another layer here that it's legacy behavior as well. It's not just technology. It's about talent. I think there's a massive ecosystem that will actually support this change. We're here to talk about tech, but it's very binary thinking. The impact that tech will have on the talent pool in the insurance industry, succession planning, all of that will play key parts in how it moves. We shouldn't underestimate that a lot of this is anchored in Lloyd's, how Lloyd's operates, and it is the epicenter of insurance, so it will certainly have an influence around how the rest changes around the globe. But I do think that behavior is a key part of this. And in fact, how we engage the insurance market, MGAs, etc., it's all around driving different behaviors. So I think we need to bring the two together more and not have them as separate components.
Let's move on, Toby. You don't even know what legacy tech is, so you're too young. On we go. So this, I find, Paul has talked earlier about fundamental change of business model. The insurance industry has relied really heavily on business process outsourcing. Huge businesses built around performing low-value tasks on a kind of wage arbitrage basis. When you look at the sort of thing that all of our tech partners have been talking about today, I can't see any reason why you would send tasks out to get someone else to do which your bots can do for you. I mean, is this the end of business process outsourcing? Toby, any thoughts?
One experience that I keep on thinking about in terms of how AI will change the way we work is, and again, you've seen that I like to tell stories. So I'm going to tell one quick story, which is that we were delivering a consulting project for a COO at a large corporation. One of our brightest consultants decided, this is early on in the LLM phase, and said, you know what, I'm going to apply at that time BARD to this problem. And sent off a report that was delivered by BARD and got a note back from the assistant, what the heck is this? And it was clear that he had never even looked at the report. And so what I drew from that is that AI is going to replace your job if you're not doing your job. And so I think in terms of business process outsourcing, wherever there's value to be had from the role that someone's playing, the jobs will follow that, regardless of the technology.
So if you look at how those BPO contracts worked, you would give someone a 10-year contract, you would hand out various tasks to them, you would cut them into the savings. Who in the current world is going to give their business process outsourcing to somebody when the technology changes, as Will says, every 3 days? Paul, do you think?
I think there will still be business process outsourcing. I actually will be interested to see whether the industry specializes. You look at some industries, and if you apply that model to insurance, you could say that there will be some claims expert. They will do the best claims process, and they will do that for a lot of companies. A company will just turn its claims process over to whatever that company is, underwriting, whatever. With MGAs, that's sort of happening now. The underwriting is getting turned over in a lot of ways to the MGAs. But I do think, to your point, that an awful lot of the outsourcing will now be done to the AIs, and that will be done internally rather than being done with another organization.
I think I would agree with that, is that the business process will still be outsourced, but it'll be outsourced rather to other people, to organisations that may use technology to do it. And they may have economies of scale in their ability to invest in that technology. But I think perhaps the only thing that won't be outsourced is the balance sheet.
To just underscore something Toby said, I've seen people say that you won't lose your job to an AI, but you may lose your job to someone using an AI.
Next one. This is deliberately provocative. The question I really want to ask: will we still need brokers? How many brokers in the room? Oh, good luck. So my sort of question is this, really. In the end, brokers can invest in this stuff too. So brokers in the end will have the power to make use of this, and they will therefore increase the value. So will brokers use the tech in order to take a lot of these tasks themselves and then present you, the underwriter? At the moment, they're happy to send you an email and you have to do all the work. But they could use this technology to do wonderful things and send you everything you need at source. So my question really is, will this reduce your dependence on brokers? I mean, you always need sources of distribution, but what's your relationship going to be with the brokers? And are you prepared to pay more for the services they provide because they're now providing more services, or are you going to pay less because you're going to invest heavily and your bots are going to do it?
So I think, the question it's a pretty general question. If you go into specifics, and if you think about follow forms, portfolio, client treaties, sidecars, commissions will be made up from that. I think what you're seeing is, in a value chain, the broker is getting closer to capital, and they're pooling capital a bit different. So they mightn't get their commissions from traditional insurers, but they will get their commissions from, whether it's looking at hedging, whether it's looking at ILS. They're thinking about capital very differently. And one thing I would say is that, and I actually haven't heard the word today, and I know that's pretty controversial, but we're not talking about the client. And clients are looking to get closer to capital. And I think you're seeing that value chain is becoming smaller. So brokers are thinking about commissions a bit differently. In fact, if you think about Europe, certain countries in Europe, it's illegal to get commission. So they're thinking about fees, value-added services, et cetera, et cetera. So I think in terms of their remuneration, that might stay the same or even increase. But the commissions and how they earn their commissions, I think, is going to be actually influenced by what clients are seeing as well. Because if they're working for the client, then the client will pay a fee if they're delivering value. So again, I think there's different vehicles they're actually producing and putting together. And we're seeing this in all the big brokers out there. They are pooling capital from a number of sources, and I think they're thinking about, how do we get the commissions to stay the same? But I also think rates have an impact on this too. The rates are going down, commissions gone down. So,
Andy, that raises two questions. Does, over time, the client and/or the broker get closer to the capital and control? They are ultimately the controller. They don't need lots of insurance companies on their way through to the capital, or is it the other way around? Does the capital find its way back to its source of distribution in a way that's far more efficient than right now?
So strictly speaking, if I answer your question, which is, will commissions have gone up or down? The answer is yes. And I know I'm correct with that. But I do think that we talked about this on our briefing call, there's some things we're not allowed to discuss. We're not allowed to use the words that brokers will be cut out of the chain. Those words are forbidden. But what you can do is you can say, oh, well, the reinsurer is putting capital behind the MGA. That's permitted. You are allowed to say that the broker are going to have facilities. That's okay. You're allowed to have embedded insurance where there is no brokerage. That's okay. So I think to your point, what we're going to see is the evolution of different sort of capabilities. And again, this Zen-like phrase is that there is a race in the market between distribution and capital. The race is, will distribution find alternative capital quicker than capital will find alternative distribution? Because both of those things are going to happen.
So one point I'll add, I agree with what Tracie and Andy said, but having watched this movie a few times, what's going to happen isn't entirely rational because the brokers have a stranglehold on people in a way, say, that realtors have in the US and have exercised to stave off sort of innovation that seemed quite obvious for decades now. I have a friend who owns a car dealership. I told him 30 years ago he needed to sell it because the car dealership model was antiquated. All you needed was a showroom to go test a car if you wanted, order from the manufacturer. It's a lot more efficient to get the car exactly the one you want, color you want, so forth in 2 weeks. That works. I'm probably about to buy another car from him because he's still very nicely in business these days. So just because there's a line in Silicon Valley, never confuse a clear view with a short distance. And I think a lot of times, I certainly have been guilty of seeing that that's the rational outcome we're going to get there, and it takes an awful lot longer than I thought.
But can I just say, when you opened up this question, you didn't just talk about commission, you talked about the brokers not being part of that value chain. Don't underestimate regulation. And we know that brokers don't take risk on their balance sheet, but it does protect the insurer against E&Os. So again, there's other influences external that are actually going to influence how this turns out. And that value chain is going to become constricted. But I think I'll just touch on, when you think about all the losses that have come through, whether it's from climate issues and discussions around net zero, I will say that there are certain industries in particular the energy industry, wants to get closer to capital and wants to get closer to the carriers. So that role of the broker is really being tested as to the value they're bringing. And then can they credibly validate the revenue that they're earning when that capital and client is becoming closer? But on certain industries, we're seeing some of that changes come through already.
Robin, and I might just add to that, it's a related question is, does it really matter? Right? I mean, commissions go up or down. What really matters, if they do go up, will that be enough? And so what we see with a lot of brokers is they're struggling and racing to automate, to reduce costs. And that will really be the clincher, is if they can introduce new technologies in a way that allow them to differentiate and continue to command the commissions that they do.
Look, when we first started digital trading, everyone said it would be disintegrating technology 25 years ago. Just absolutely, the model's not changed one iota in 25 years. Sorry to put you on the spot, but are you and your leaders in the least bit interested, least bit threatened? Do you sense that there's a kind of, my God, what happens next? How do we react to this?
To clarify, I'm a reinsurance broker, so Tracie, everything you were saying was completely true. I think at one point you guys haven't discussed, which we see as real value to our clients, is benchmarking and portfolio optimization, and often clients come to us for that information because they don't have it and we have it. So that's one of the true values of it. I work for Gallagher Re. We're spending a huge amount of money on our digitalization. It's a 5-stage process. It's going to take about 7 years. And by the time that ends, the value the clients are going to get from it is going to be unbelievable. They're going to be able to log into portals, API in their information, benchmark automatically. And then on the other side, we're going to be able to deliver fantastic transactions using different sources of capital really quickly. And yeah, I think it's going to be pretty transformational.
Thank you. Unlike the BBC, we have to give a balanced view here at InsTech. We have to have all perspectives. Right, what's the next question? Toby, you can start with this one. People have been talking about this for a long time. Why do we need an annual renewal? This is a reset because you need to collect the information that enables you to reprice. But if that information increasingly is available all the time, will we have annual renewals?
Well, currently, there's some instances where annual policy renewals don't happen, whether it's parametric, whether it's evergreen. And then there's a focus on, could it be just a trigger policy as opposed to an annual renewal? But I think it's not just, we're talking here around primary, but it goes through the whole layer. The reinsurers would have to agree to it as well, because obviously everybody's talking about the treaty. And then you have to think about the investment strategies of the insurers. So there's a number of things, but I would say parametric in particular has taken off in the last probably 36 months. And I think that is influencing what we're thinking about in terms of renewals. And I think we're going to see more of the agnostic approach to renewals.
Paul?
I've published a little on a term that some people are using, continuous underwriting. And I believe in that concept. There hasn't exactly been a groundswell around it, but I certainly can't imagine why in this day and age, if somebody adds a mechanical bull in a restaurant, why that wouldn't immediately get to the attention of an underwriter and change the policy, a fryer or whatever.
I agree. So this is another perpetual discussion point, which is everyone talking relentlessly about consolidation. Are any of the things that we've talked about today going to drive further consolidation, more or less insurers? And UK and US, perhaps, Andy, you can give a UK perspective and we'll get Paul to give a US perspective.
Sure. So I think that one of the things in the insurance market is it's incredibly difficult to build a massively strong balance sheet. If you want $100 billion plus of capital on your balance sheet, that's not a small task. And so I think that there will still be approximately the same numbers of balance sheets out there. However, I think the routes to market for that balance sheet will absolutely change. We talked earlier about the fact we're living in the age of the MGA, and so capital is being deployed in numerous different ways. And so I think what we're going to see is a sort of expansion and contraction of these sort of large groups of MGAs, which are experimenting right at the edge of many of the things we've talked about, which is, consulting directly with the customer, different routes to market, non-annual policies, etc. So I suspect that combined with the technology we've just seen, with the proliferation of data around the assets that are being insured, I think we're going to go through waves of innovation and then market consolidation.
Doesn't so much of it depend on what happens to the market? So, for example, over the break, speaking with Axis Capital, founded just after 9/11, right? When if you had the capital, there was money to be made. And so who can predict what's going to happen? I mean, obviously now we're in a period where there could be tremendous turmoil in a very short while, which would open up opportunities for new insurers if they have the money there to deploy.
The challenge you have, though, is that when you think about where they're looking for funding from private equity, they have a very different view on their ROIs. And that's the struggle you have, is the insurance returns are at a very different level to the PE. So again, it's, can you get the right fit? I think we're going to see more consolidation. And MGAs, for me personally, I think they're a vehicle to go to market. Is it sustainable as we see them coming up more on the monoline? But I don't see it on the multi-line.
They get quiet over time, presumably.
So I don't know how many insurance companies there are in the U.S., mostly because I can't count that high. I once saw the number 6,600, and that strikes me as just an unbearably high, an unsustainably high number. And I understand that specialization, which I think is going to increase, will keep the number fairly high, as does the peculiar way the U.S. regulates insurance. You go state by state. But if you look at the history of technology businesses, they are not quite winner take all, but winner take most. I started covering IBM at a time when the rule of thumb was that it accounted for half the computer industry revenue, 2/3 of the profit, and 3/4 of the market cap. And you look at Apple, what it's doing, Google, what it's doing in search and so forth, you see that sort of thing. So I think the pressures of investing in technology, the expertise that goes with it and so forth, will drive a lot of consolidation.
Okay, on we go. Next question. So, will you still have a job in 10 years' time? Not quite what I mean, but, ultimately, this tech is going to be very disruptive. Quite a lot of the jobs that we have now, particularly around the more bureaucratic end, may not exist. I'm with the audience on this one. I was surprised it's not more.
So just on this, I think you're going to see back office jobs obviously decrease. As somebody who has 28 years in the industry as an insurer and a broker, I hope that the brand of the insurance world actually gets better and there is more focus on underwriting, where the skills and talent that tech can enable to bring into this industry, the insurance industry, is going to just be fantastic, and we can be better at building that brand. So that's where I see that the tech enablement can play a big role, is because then the differentiation for our client is around the underwriter. What is the underwriter bringing to the table? Because the stakes are even. And so it really gets the insurers to think about differentiation. I'm hoping that you're going to see some on the back office go down, but on underwriting, I hope we get more people into the industry who think about risk a bit differently, and actually that the tech and everything we're talking about here today makes those pain points in their jobs a little easier, but it has them focusing on what they're good at and what their skills are.
Someone from my ad, if you look into the working population of the US, which I think is about 150 million people, something like 1% of the population, slightly over now, derives their primary source of income directly or indirectly from the Apple App Store. Yeah, this is a technology that didn't exist 15 years ago, and now it's employing 1% of the working population. So I think if you look at the technologies we've heard about today and think about the change of skill set in an organization, and take someone like Key Underwriting, who did $1.4 billion last year. If you look at the demographic of their employee base, of how many technologists they've got versus how many insurance specialists, I think you're getting a glimpse into what the insurer of the future is going to be like. So I think, personally, I'm an optimist. I think there'll be more people employed because I think more insurance will be out there. The nature of the jobs is going to be night and day from what they are today.
Yeah.
Just to back on Key, they've got 3 active underwriters doing 1.4 billion and 65 data scientists. So they haven't reduced their headcount. They've just reprofiled the AI.
Yeah.
I'm old enough to remember when ATMs were introduced and were supposed to replace bank tellers. And there are now more bank tellers in the US than there were when the ATM was introduced. So I think that's mostly what's going to happen in insurance. Certainly the back office jobs will go away. There'll be a lot of other efficiency, but I think people will be repurposed, especially because they believe in the predict and prevent model. I think Deloitte came out with a study the other day saying that services revenue in the insurance industry was going to something like double. I don't know if it was just in the US, North America, whatever, but from 20-some billion dollars to $44 billion in the next few years. And I think there'll be a lot of people employed doing that sort of thing.
Paul earlier said that one of the things that excited you so much about the industry was that insurance drives innovation. So if you believe that innovation, the overall economy will continue to grow, insurance is going to play a key part. And granted, it may move from the back office to the data scientists and more sophisticated underwriters, but I'd have to join the 20% who believe that it's going to grow.
You've recently got lots of bank tellers is because you still send checks in the US. Most of us have got rid of them a long time ago.
I had to find my routing number the other day and I had to find a checkbook. I hadn't written a check in, I couldn't tell you how many years.
So the next one, what I want to know here is a bit like the Key. Will there be insurance companies which don't have any underwriters? And no underwriters at all. They're simply a combination of tech, data scientists, and other. In other words, the concept of underwriting has disappeared. We don't need them because all the attributes you need to assess and price risk are done by a combination of other skilled tech and workforce. It's a slightly similar question, but again,
I think we'll see it in the personal lines. In the specialty, I'm a no, that won't happen, especially not for your big property cat and everything else we're seeing. And we'll cover that in the protection gap question. But I would say in personal lines, I mean, even when you think about the insurance that we buy, I mean, renter's insurance and my house insurance, I never talk to anybody. It is just automatic. And I never want to talk to anybody, but that it's great. It just happens without me even thinking.
not even your toothbrush.
No,
No.
definitely not.
I totally agree.
Yeah, I think we're all right. Anyone?
I was going to say that I think this is already happening today.
Yeah.
Yes, if you look at, I was going to the example of motor insurance. Motor insurance is price and distribution. There's no real sort of human underwriting. But I think the other challenge in there, which is related, is that I heard a statistic last night actually, apparently that 60% of all the underwriters in the market today are due to retire in the next 10 years.
Yes, that is.
So we may actually be forced into a situation where people have to operate without human underwriters, or fewer.
That's certainly happening in the claims space. Yeah, I'm quite intrigued to see what we all think about the future of work. Are we going to carry on working like we are now? Will there be more or less remote working? Is there any trend one can establish here?
Well, I think if you look at Lloyd's in particular, there's been a big push to get back into Lloyd's, and I think they've done it well. For me personally, I am sit down with your colleagues, collaborate, talk about the risk, etc. That's how I personally operate best. But I think this is a general question to all industries. But I do think in insurance, As outdated as people might think that Lloyd's is, there is nothing better than going in and sitting in front of somebody, building trust and confidence and placing a risk. And it's a great learning curve for all the people that we want to bring into this industry. Send them to Lloyd's and get them in front of a seasoned underwriter who's going to challenge them on, do they know their risk? So I think it'll probably stay the same, but I hope that it will be less remote work. But I'm probably the odd one out here.
I think the economy is a bit like the California earthquake. That's long overdue. And in the economy, unfortunately, there's going to probably be a bump in the road in the next 10 years. And I was trying to work out the maths just now, but I think anyone who's probably under 40 probably hasn't witnessed a significant economic downturn in their working life. And when that happens, sadly, and it's an inevitability, when that happens, I think employers are going to say, well, actually, we'd like to keep the people who will come into the office 5 days a week. And that's going to just change things. Not for all industries, but in the insurance market. Because I think a lot of the executives in there are used to having that face-to-face, face-to-face interaction.
The other thing I would add to this is, and it's a message I would give anybody, is, to be visible. And if we think about, during COVID, in the insurance industry in particular, and I worked directly in the insurance industry at that time, the demographic that suffered was females because they weren't on the golf course, they weren't doing the deals. And so I think being visible and being around and, I think the remote working, okay, I get it, but I think it is important if we have anything that we can push for that too, if we think about progression.
Well, we certainly have a particular view here at Google. If anybody didn't only sample the buffet out here, but went to the cafeteria, know that we invest a lot in order to get people in person. And it's been on an upward trend, thankfully, since COVID. Our CEO, Sundar, recently said that since COVID, and particularly during COVID, we were running on an investment that we had built in terms of our interactions for years, but that deposit was dwindling. And you need to get back in person in order to build up those connections again. And I think it goes back to our comments about how the work will shift from the back office, perhaps to the underwriters with even more knowledge. And when there's more knowledge required, you're not going to do that over chat and video conferencing.
So I'm a total remote work guy. I agree with everything that was said, and I can see the corporate desire to bring people back and can see creativity happening and trust and so forth. It may be that writing is pretty much a solo profession. Red Smith used to say that writing is easy. All you have to do is put a piece of paper in the typewriter and stare at it until beads of blood appear on your forehead. And that's kind of the way it works. I've been working remotely since 1996, and I'll tell you that some of the moments I treasure the most were when my younger daughter was in nursery school and she'd come back. I'd hear the backpack drop by the front door. She'd come running into my office and hit me so hard she'd almost knock me over backward in my chair. And I think there's demand, especially among younger people, for that sort of thing. So I think there are going to be countervailing forces there.
Right. So it looks one of the other big issues is the protection gap. We've been talking about it for a long time. And there's some, scary stats about the proportion of total risk which is insured and the majority is uninsured. What does that mean? Does this tech that we've been talking about and all the models and predictive capabilities that we're building mean we're going to close that gap, or is the world in which we operate going to have more and more risks that we don't understand and we're never going to quite catch up with ourselves? Paul, go on.
So I think that's a hard one. I think the protection gap is sort of like the legacy technology issue. I think it's always going to be there. I'm concerned about what's happening in the U.S. now because we seem to be blowing up FEMA. I don't know if people saw, but apparently the new director of FEMA said the other day that he wasn't aware that there's an annual hurricane season in the U.S. He claimed he was joking, but the people in the room said they didn't think he was joking. So I think government's going to have a lot to say about that, and we'll have to see how much government steps back.
But I would say as well on some of these, and FEMA's point in case, to really close it, you need public and private. It's not either or, and especially around climate. I think my last role before coming into the tech side of things was the global head of climate. And I think some of the tech that we're seeing around predictive modeling from 1 year to 100 years out and looking at the propensity, it's getting really sophisticated. So I think there's potential to close the gap, but it's how fast we can move to close it.
I think the last question is that the next question involves the use of devices, etc., to understand risk. So if you were to lay out risk on a chart, saying good risk to bad risk, you would see that the majority of risk sits in the middle like a bell curve, normal distribution. And so I think if you sit on either end of that chart, you have a coverage protection gap. Because if you're fundamentally a bad risk, no one's going to insure you. Yeah, so you're going to have a big gap. And if you're fundamentally a good risk, then you're probably not prepared to pay for the coverage that you want. So both of them will have to live with protection gaps. If you sit in the middle, you'll be fine.
Yeah, that's a nice thought. Last question. Will we still be having panel chats like this in 10 years' time? Yes? Well, you will be remote working, so you won't be able to get here. Okay, thank you very much, both to the audience and to my panel. Thank you very much.
Thank you.